Okay.
Richard?
Peter, Peter Havens and I'm Richard May, welcome you to the January 2025 Baldwin Investment Management client Zoom call. And the title of this is based on what was Peter Havens' commentary written at the beginning of the quarter called The Road Traveled and Perhaps the Road Ahead, has a subtitle of the road travel and perhaps the road to come. Peter, you want to sort of introduce the topic, and then Chrissy can do the rules of the road?
Sure. Thank you, Richard. This is a quick look back at markets during 2024, the economy and markets, and then a look forward throughout 2025 as to what we expect might happen, with some caveats, because as we all know, the environment changes almost minute to minute. So with that, I'll turn it over to Chrissy to give us the rules of the road.
Hi, everybody. I'm Christina, or Chrissy. I'm just going to share my screen. For those who have been with us before, we kind of go over, this is kind of what the expectation is. And I'm just going to share it here so we can just go through those slides very quickly. We ask that during the presentation, just keep your session on mute, please, just so we don't have a background noise, and that make sure that everybody who's participating today can hear the presenter speak. When and if we get to the QA section, and if you have a question, you are definitely free to unmute yourself when you're called on, and we'll go through how to get into the queue for that as well. When you do have questions, if it's in the middle of them talking, that's fine. We will take questions at any time. Just use the raise your hand feature in Zoom. When you do that, I will then select you, you'll unmute yourself, ask your question. When that question is done, we just ask that you remute yourself, just so, again, we don't have the background noise. The way that you can get your question, your raise your hand feature, for those who haven't done this before, if you're using the Zoom application, there's a little reactions button at the bottom, and in that reactions button is a raise hand button, and it'll show a yellow hand that just goes up. That will then put you in the queue, and I will see your name come up with a yellow hand, and I'll be able to call on you if you have a question. And then to take yourself out of the queue, you just hit the same function. You go to that reactions button, hit the lower hand, and that will then take you out of the question queue. If you're joined by phone today and you want to ask a question and be put in the queue for that, you can dial *9 on your phone. That will add you to the queue. I will then unmute you and then ask you to ask your question. Once you're finished, then you can dial *9 again on your phone, and it will take you out of the queue. So that is basically the general rules of the road. If you have any questions, feel free to shoot anything into the group chat. The meeting chat. We are paying attention to that. If you have a question and you don't want to verbalize it, feel free to put it into the chat box. We will read it aloud to the presenters and they will answer it for you. And then we are good to go. Peter, back to you. Richard.
Well, Richard, off to you. Let's
Richard.
start the conversation.
So let me start off by actually, Peter, with your permission, I'm going to quote some of your commentary to lead off this discussion. Looking back at the last part of 2024, we had corporate sales were up, earnings rose again better than expected, cash flow exceeded expectations, employment levels are remaining robust. The inflation that had bothered the economy had abated somewhat, and the Federal Reserve was beginning to reduce interest rates, and the very much anticipated recession that was supposed to develop in 2024 never happened. So this is like all good news, and the stock market and the bond market reflected that. Both the stock market had a really robust year, and the bond market had a better year than some anticipated. So it certainly looks like in many ways that we have a little bit of a Goldilocks economy as we enter 2025. And I mentioned that to Peter this morning in a brief chat, and he said, "Well, we've had a Goldilocks economy for a number of years." What do you think explains how good it's been?
Well, I think there are a number of reasons. And Chrissy, could we go to chart number 1, please? So what you see in this chart is U.S. households' balance sheet. Now, we must remember that in the United States, 70% of our gross domestic product, or our GNP, if you will, is generated by the consumer. And so if the consumer is in good shape, then it wouldn't be too far-fetched to think that the economy is going to do well. And so here you see a picture over many years from 2004, the increase in the net worth. You can see the financial assets that people hold. You can see the real estate assets they hold, and you can also see how little debt that the U.S. consumer has got. And so as financial assets have gone up, as real estate values have gone up, and most consumers have been really quite good with regard to borrowing too much money, you can see that the U.S. household, the U.S. consumer is in very good shape. And that should continue to promote more spending, if you will, which keeps our economy going. If you were to go to the next chart, please, Christina, chart number 2. Well, nope, that's 3. There we go. Nope. So here we see corporate profits as a percent of GDP. And this is essentially margins. So how profitable have U.S. corporations been? And this is a bugaboo for a number of analysts on the street who have consistently forecasted that U.S. management teams can't possibly keep corporate profits as high as they have been. And you can see that the average has been about 7% over many decades, since 1959. But it has been since the recession of the Great Recession of 2009, that corporate profits have leapt forward and have continued to rise. We continue to think that this is going to be the case because management teams are under a great deal more pressure from their shareholders to perform. They have many more levers to pull to make sure that they make their earnings numbers. And again, the world economy has tended to do pretty well. So with all that bundled up, corporate profits have remained a lot higher, margins have remained a lot higher than what analysts had been expecting, and we don't see any reason why they're going to deteriorate anytime in the near future. Chrissy, if you go to the next slide. And as another look at this, you take a look at the bond market. Now, the bond market is many times larger than the US stock market. Bond markets around the world are many times larger than equity markets around the world. And it's often been said that, bond market traders are a lot smarter than equity traders. I'm not going to agree to that since I'm basically an equity guy. But the bond market is a lot larger, and it is the dog, if you will. The tail of the dog would be the equity markets, and the dog is the bond market. And so we've got to be ever watchful what's going on. What's the mood of bond traders and bond market investors? And I think especially right now we have to be very mindful of this. Some people asked me immediately after the election, well, what did I think about what the future was going to hold? And I said, well, I would think that the stock market might do pretty well, because I think there's a lot of enthusiasm, especially with regard to reduced regulation and some other things that the administration has talked about during their campaign to make the economy grow faster. But there are also some things that they've talked about which might unnerve the bond market, especially with regard to tariffs and also sending people back to their home countries, if you will. And this could spark some worries about inflation. And if that happens, the bond market will not react well. And in fact, what we saw immediately after the election was the stock market went up, but the bond market did not. The bond market went down. So we have to be mindful of what's going on in the bond market. Right at the moment, broad brush, not getting down to day-to-day trading, this is a measure of what the bond market is thinking about our economy. This is a measure of so-called junk spread. So how much of a premium in yield that buyers of less than investment grade bonds demand over investment grade bonds to invest in those bonds. And when the junk spreads are very narrow, as they are, you can see here on this chart that they're at historic lows. That means the bond market is really quite at ease with regard to how the economy looks. The bond market right at the moment is saying that we don't see any danger from a recession. We think that the economy is going to continue to grow. We think that corporate profits are going to continue to be strong. And as a consequence, we do not foresee a recession. And so we're not going to demand a huge spread over investment grade. If you look at 2009, where there was that broad shaded area, that was during the Great Recession. And there, bond investors were scared to death that the whole financial system was coming unglued. And as a consequence, the premiums that they demanded to own junk bonds, less than investment grade bonds, the premiums they demanded were almost 1,400 basis points. So there's a huge spread over investment grade. As you can see now, there's very little spread over investment grade. So the bond market is also quite relaxed about the economy. So
Peter,
go ahead.
If I can interrupt just for a second, the worry, I have a little bit of a worry with this sort of continued drive for corporate profits to continue to increase with the relative positions of the bulk of the citizens of the country. Not saying that there hasn't been progress on return of profits to labor as well. But obviously, when the share that's going to corporate profits is growing right exponentially, is there a danger of continued unrest or dissatisfaction, or is that kind of overstated? 50% of the population seem to have no problem continuing with this drive to, I guess you might say, unfettered capitalism. Do you have a concern about that?
Well, you raise a good point, Richard. There's been an increasing amount of print concerning profits going much more to capital than they have been going to labor, income disparity, and all the social pressures connected with that. And I do think it's something about which we've got to be aware. So it is, yes, it is a possible reason to be a bit concerned about, are we going to continue down this path? I'm concerned. I have a concern about it, but I don't think under the current administration's policies you're going to see any move in that direction. In other words, I think unfettered capitalism is going to continue to be the mantra for the markets.
Well, it's interesting also because it sort of introduces the concept of American exceptionalism, which has been discussed with some frequency recently. It really didn't come up that much in the campaign, but basically there is sort of a lingering feeling that the American system or Americans themselves are better positioned in the global economy than some of our peers. You know, clearly the socialist system in Europe or the communist system in some other places doesn't lend itself to risk taking. It doesn't lend itself to continued profitability. I've read a lot recently about American exceptionalism and believe clearly the system is exceptional. Americans are better educated as well as or better than some of their peers. But we've had some discussions about that. Do you think the country is exceptional, the system's exceptional, or a combination of that and the people are exceptional to explain this advantage that the U.S. has?
I think it's a combination. I think each feeds off the other. Remember that we are a country of immigrants, people who left places of comfort, if you will, a familiar place, not necessarily places of comfort, but places with which they were familiar, their homelands, cultures with which they were familiar, languages with which they were familiar. They picked up everything and moved to a foreign land. And in the early days of the United States, they moved to basically an unsettled foreign land and had to create something out of what was essentially nothing. So it takes a certain sort of person to do that. Somebody who's adventuresome, somebody who wants to, not go with the flow, if you will. So already we set ourselves apart from, say, old Europe, if you will. And then on top of that, as these people developed this country, they developed a set of rules and regulations and laws which fostered entrepreneurialism, fostered, creating something out of nothing. The piece of paper was clean, the slate was clean. We're going to start over and we're going to create a new country here. So, and they just fed on one another. As we got more immigrants in, we had more people coming in with different ideas, bright ideas, and they were provided an environment in which they could thrive and they could exercise that freedom commercially and build businesses. No matter what you think of the fellow, a very current example today is Elon Musk. I mean, here's a guy that comes from South Africa, has built a car company out of scratch when nobody thought anybody could build a new car company, has been more successful than NASA in putting people in space, has got a boring company that builds tunnels all over. So this is this sort of environment in which people who come to this country, they're allowed to act. And so I think we create an exceptional environment. We have a society which does not put a black mark against your name if you fail. In too many societies around the world, failure is almost like a death knell. You'll never recover from it. Not in this country. In this country, we champion failure. We say, okay, fine, you failed this time. Pull yourself up by your bootstraps and try something else and try another time. And there have been countless stories about how people failed on the first, second, and third attempts, and then on the fourth attempt, they made good. So I do think we are an exceptional people. I think we have created an exceptional environment, and that has allowed us to continue to be the world's leader economically. And I don't see anybody on the horizon. People were thinking, maybe about 5, 10, more like 10 years ago now, that China was going to overtake us. Well, then entered this fellow by the name of Xi, who's the president and who's the most powerful man since Mao Zedong. And he's changed the whole complexion of society and the economy in China. He's brought the party back up to the supreme position as it was under Mao, but had been allowed to, if you will, take a little bit more of a back seat to some entrepreneurs like Jack Ma and I forget the man's name, Pony. I think it's Jack Pony. Two storied entrepreneurs, Jack Ma at Alibaba and Pony, I think, is at Baidu. But she came into office and grabbed the reins of power, silenced his critics, and now he's making all the decisions. And now you see the Chinese economy faltering and not doing nearly as well as it was expected to.
And the shame of that is that the Chinese people, I think, are naturally entrepreneurial. They're smart, they're driven, but if the risk-taking societal structure is not there as it is in this country, it's not going to work. It's not going to do anything.
Exactly. If Christina, if you go to chart 5,
Perfect.
Here you'll see a chart entitled Garbage Work. So this looks at Chinese youth unemployment in 2024. It was in excess of 16%, like 17%. And whenever you have young people who are unemployed to that extent, you start creating discord in society because they've got nothing to do. They start getting bored. And that's when you start having pots and pans being banged on balconies and people expressing discontent. And if you go to the next chart, Chrissy, which is chart number 6, here you can see a manifestation of that. So this represents the Shanghai Exchange and also the U.S. exchange, the S&P 500. And you can see that, for quite a while they were sort of going back and forth and back and forth. But then beginning in around 2020, you can see the U.S. market beginning to separate itself from the Chinese market. And this is because this is when Xi really cemented his power. He come into power several years earlier, but he hadn't cemented his power. It was about this time that he successfully ran for a third 5-year term. That had not happened since Mao was in power. And so he has been so successful at silencing his critics that nobody dares challenge him. And as a consequence, he's making all the decisions. And so you've got youth on unemployment. So you've got young people who are dissatisfied. He's torn down whole industries like the education industry. And it's reflected in the stock market, where a number of people are now declaring, and have for a couple of years, declared the Chinese market uninvestable.
Interestingly, I visited China in 2008, and that was just about the time that Xi took power. I think he was sort of consolidating his position, and part of that drop in 2008, where China was well above the U.S. market and came back to closer to parity, was the 2008-2009 mini depression, the Great Recession. But remember, China was sort of kept on ticking while the rest of the world was kind of falling by the wayside, and China kept the world economy kind of going for several years. And then, fast forward to 2020, the Chinese went into dark mode and effectively never came out.
Correct.
They came out of their caves, but they didn't come out of their doldrums.
Correct.
So,
right.
We have a question in the chat. It says, isn't the disparity more of a function of the lockdown that happened throughout China during the pandemic?
Well, I think that's true, and I was referencing that, and unfortunately, I think it might have changed the attitudes of the Chinese people coming out of the pandemic. Everything they've tried hasn't worked.
And we must remember that it was Xi that made the decisions with regard to the severity of the lockdown. He refused when we were beginning to open up and other countries opened up. He refused to open up and created a great deal of consternation in the population. Businesses were going out of business. Nobody was getting anything done. And that's when it wasn't until there were a series of rallies, if you will, on apartment balconies where people were leaning out their balconies and banging on pots and pans in Shanghai and in Beijing and in Guangzhou, that finally Xi yielded and decided he had to start opening up the economy. But they still not recovered, and they've not employed any tools to really help them recover. They've been basically applying a Band-Aid to a gaping economic wound. And that economic wound has to do with the collapse of their real estate market, which again, Xi forced, because he thought some real estate developers had gotten way too powerful. And so he decided that he had to shut them down to teach them a lesson. Unfortunately, what he forgot was that these were very highly levered companies. And when he shut them down, the whole house of cards collapsed, and they've not been able to recover since.
Yeah, I mean, I don't think Xi understands the way the economy works.
Mm-hmm.
And I think, it's a combination of things that contributed to the malaise that exists there now. Clearly, Xi's crackdown had a lot to do with it. Clearly, the lockdown during the pandemic had a lot to do with it. And it's also conceivably the Western world putting some of these tariffs on Chinese goods in 2017 and beyond. And I think you have a chart that either reinforces this or dispels this.
Well, I think what it does, and so Chrissy, if you can go to chart number 7, I think what this chart shows, here we are, is that tariffs really don't work very well, despite the fact that they're pretty popular these days. At least they're talked a lot about. They don't work very well. So this is looking at the surplus which China has generated for quite a few years. And despite the fact that during the first Trump administration, tariffs, very high tariffs, at least relative to history, very high tariffs were put into place during the first Trump administration, and they were maintained during the Biden administration, and even more tariffs added during the Biden administration, and it doesn't seem to have had any effect at all. If you look at 2024, the deficit is approaching $1 trillion with China. And so as a consequence, you sit there and say, well, we've had these tariffs in place since I think it was like 2017. And yet the trade imbalance has continued to grow. And so what's the point of having these tariffs? And there are a lot of people who would argue, me included, that they really don't do what people who are very much in favor of tariffs, the way they advertise them. They just don't. What happened during the first administration when the Chinese tariffs were introduced, the Chinese reciprocated. They introduced tariffs on U.S. agricultural exports. Our farmers lost the Chinese market to the Brazilians, and in fact were in such bad economic shape that the Trump administration took money raised on tariffs they collected for Chinese imports and doled it out to farmers. So some slice of American society was paying higher prices for various goods that were imported from China, and that money that was collected was then recycled to American farmers who had lost the Chinese market to the Brazilians, and the Brazilians still have that market. It's going to be very hard for us to earn that market back. But that's what happens when you start, if you will, artificially influencing markets. If you don't allow the market to act as the market, goes to natural strengths, then you get these sort of collateral effects and collateral damage.
So the tariffs are one aspect of upcoming American economic and foreign policy that are a bit problematic, I think, in the view of something like 80% of economists think tariffs are a net negative. But combined with that, just to summarize the discussion, there's so many positive aspects that are in place right now. The fact that we're adding deregulation is a positive aspect. The tariffs are a headwind, but the question is whether the positives from the deregulation, the perhaps lower or at least reinstated tax rates from 2017, whether all that's positive enough to outweigh the tariffs and maybe some net effects of the mass deportation that might have some inflationary pressures as well. So it's going to be an interesting period of time. Peter, we had 2 other topics to discuss. We're halfway through the call, and I want to, if I may, introduce the oil patch to the discussion. Clearly, there's a lot of stuff going on in energy right now, and I wonder if you can give our guests a little bit of summary of what's happening on the oil patch these days and what it means for not only U.S. companies, but also the global supply and demand.
Sure, sure. So if Chrissy, if you go to chart number 10, please. So here you will see a graphical display of production, which is coming out of the Permian Basin. The Permian Basin is the largest oil or hydrocarbon basin in the United States, and it's one of the largest basins in the world. And the Permian, which was formed over millennia, has been producing record amounts of oil for generations, not just years, not decades, but for generations. And right now produces about half the oil we've got in production today. The United States produces about 13.5 million barrels a day. And you can see here the Permian produces about 6.5 million barrels of that. So we're a major oil producer. In fact, we are the largest oil producer today in the world. And if one thinks about the future of oil and how we're going to effectively find more oil within our borders, one of the great uses of artificial intelligence is going to be in the oil field and is in fact already being used in the oil field. So, Chrissy, if you would go to the next chart, which is chart 11. So here you see production costs. And if you go back to January of 2012, and again, and this is in the Permian, production costs were north of $90 a barrel. And now, if you go to 2024 to the far right, you can see production costs have been lowered to about $40 a barrel. Now, when production costs were close to 90 some odd dollars a barrel, it was very hard to make any money in the oil business when the best you were going to get in the marketplace was about $100 a barrel. So technology has been applied to horizontal drilling to enhance the productivity of Permian wells and lower the cost of producing a Permian well. Schlumberger, it's now a company called SLB, which is the largest oil service company in the world, has opined that it used to, when somebody would drill for oil offshore, typically one of the first steps after they lease up ground, they'll run seismic surveys. And essentially what that is taking sound making machines and basically creating an echo underwater, which then bounces off the floor of the ocean. And the time it takes to get back up to various sound capturing cones, they put that measurement through all sorts of algorithmic calculations and determine whether there are hydrocarbons beneath the surface. And they're very accurate down several miles, because I'm sure you all have heard about people offshore drilling 2, 3, 4, 5 miles beneath the surface of the ocean. It used to take, according to SLB, it used to take 18 months to get the results back from such a seismic survey. Through the use of AI, oil companies can now read the same seismic survey, get the same interpretation more accurately in 18 days. So you've gone from 18 months to 18 days, which dramatically lowers the cost of drilling an offshore well, which are already very expensive.
And And reducing the risk as well, wouldn't it, Peter, also?
Exactly, reduces the risks too. So they're also using AI in the Permian, and through various calculations, they are determining where to perforate the drill step. So when you drill a horizontal well, you go vertical down a couple thousand feet, and then you swing out and start drilling horizontally. And then once you're finished drilling, once you've bored that well, then you send explosives down, and at various intervals along the horizontal stretch of the pipe, you're going to set off these explosives. They'll perforate the well bore and allow oil to collect in the well bore, and that's how you get the oil out of the well. And more efficiently, we're able to do that, or drillers are able to do that these days because of AI. So we're cutting down on the expense of exploration. We're cutting down on the risk of exploration in offshore. We're enhancing the ability to more productively produce Permian wells, which have been in production for generations. As I said, the basin has been in production for generations, and so with all that, we're able to find more oil, produce it less expensively, and continue to drive the cost down and margins up. So AI is going to be used very successfully in a very capital-intensive business like the oil business.
May I interrupt for a second?
Mm-hmm.
Chrissy, you can put that slide back down if you would. I wanted to just briefly think aloud that declining cost of producing hydrocarbons probably does stall the concept of clean energy coming on board. Obviously, there in the last 5 to 10 years, there's been a surge in solar, geothermal, wind energy, and I think a little bit of this declining cost, as well as the success of fracking, as well as the kind of current political environment, maybe takes a little bit of this pun is intended, a little bit of the wind out of the sails of the clean energy industry. I know the Europeans have placed a pretty substantial stake on clean energy. Some of them are planning to be hydrocarbon free by 2030. I wonder what the global implications of all this is for solar, geothermal, wind, and hydroelectric.
I think it continues, but at a slower pace. BP recently announced that they're going to gear way back in their alternative energy effort. It's not been terribly successful as it is, and shareholders are clamoring for profits, not for new solar efforts. Total, the big French integrated, has also made public that they're going to cut back on their alternative energy efforts. You saw perhaps yesterday Ørsted, which used to be the old Danish national oil and gas company, has taken a huge write-off. They got rid of oil and gas several years ago. They went entirely into offshore wind. They announced yesterday they're taking a huge write-off in the fourth quarter of last year, basically to write off, if not entirely, largely their North American exposure, because projects have been held up with regulatory kerfuffles, if you will. And it's a business which is very dependent upon the capital markets, and capital has gotten much more expensive in the marketplace. So they just have determined that some of these projects are no longer viable. So they're writing them down and or writing them off in particular. So again, the alternative energy is going to continue to grow because in certain places it makes a lot of economic sense. But where you need massive tariffs to have it make sense, it's going to slow down rather dramatically.
As a comment just came in, Europe doesn't have much of a choice because they don't have the natural energy sources that we do here. Obviously, the Russian invasion of Ukraine has also made Germany kind of a little bit of dead in the water as far as their energy sources. But I know President Trump has tried to tie the avoidance of tariffs to European purchases of liquefied natural gas. I wonder how successful that effort will be to get more LNG over to the Europeans.
Oh, I think it will be very successful because we're already exporting a lot of LNG. And the Europeans, to Europe in particular, and the Europeans, when Russia first walked into Ukraine, people thought it was going to take forever for the Europeans, especially the Germans and the Dutch, to get up various LNG processing plants along their coastlines. And I guess if there's a will, there's a way. They found the will and they found the way, and they put up plants in record-breaking time. So I think there's going to be even more of that. I think Mr. Trump is going to be successful in his argument that we've got quite a trade imbalance with Europe. A way to cure at least part of it is to be buying more LNG. Their argument has been for a bit of a while that, well, you don't have the plant capacity to ship any more to us. He is just, remember, the past administration put a pause on the construction of new LNG plants. That pause has now been lifted, and those plants will be going forward to FID.
So if there's a moral to the oil and gas question, don't sell your Exxon stock yet. Be patient for your return on your solar companies, and keep a watch on your own personal energy use, because that's probably, the prices are probably going to sneak up one way or another. I know there's an issue with Canada. If we indeed put some tariffs on Canada, the supply of oil coming in from Canada might be either pricey or constrained in such a way. And you were explaining to me earlier the processing of the crude from Canada compared to the processing of the crude in this country.
Sure. So, if, Christina, if you go to chart number 8, so this is from the U.S. Energy Information Administration, and this takes a look at the U.S. imports of crude oil from Canada and the rest of the world. And what you can see is that the importation of crude from Canada has risen quite dramatically over the years, and from the rest of the world, it has shrunk. Now, primarily that's because the U.S. is producing more of its own crude, so we don't need as much from the rest of the world, but we do need Canadian crude. And why is that? Go to the next chart, if you would, please, chart 9. Because the U.S. refining geography, if you will, is built in 5 pads. And you can see them listed across the bottom of the page here. And if you look at pad 2 and pad 4, pad 2 is being in the Midwest and pad 4 is in the Rocky Mountains. It is there where almost 100% of the oil that gets refined in those 2 locations comes out of Canada. And why is that? Well, years ago, and I'm now talking about 25 years ago, 30 years ago, it was determined by various experts around the world that the world was running out of light sweet crude. And as a consequence, and what I mean by light sweet crude is this is crude that's very high quality, that's very easy to refine into diesel and into gasoline. But the world had a plethora of heavy sour crude. So this is crude that is much more difficult to refine into gasoline, in diesel. And so the refiners in our country made the decision that we had too much refining capacity. And so what they were going to do is they were going to shut down all the refining capacity we had for light sweet crude, i.e. easy to refine crude, and invest only in more difficult to refine crude because the world was running out of light sweet crude. Well, so we upgraded our refining capacity as far as quality. We could refine lesser quality of crude, and we got rid of all our refining capacity that was available for refining high quality crude. Well, then we discovered the shales. The Permian Basin is a shale play, and the oil that comes out of the shale plays is all very high quality crude, and thus not available for our refining capacity. And so this is the sort of crude that we export to Europe. The Europeans did not upgrade their refining capacity. They are dependent upon higher quality light sweet crude to refine into gasoline. Our refining capacity, which we invested a lot of money to upgrade the quality so we can refine more difficult crudes, lesser quality crudes, we can't use the crude that's being produced in the United States. But Canada, that's basically all they produce. Lower quality crude out of tar sands in particular, but in various other formations. So the point of all this is we import a lot of Canadian crude. It's most of what Canada exports to the United States. We import a lot of cars too and other stuff. But I believe I'm correct in saying that the majority of their exports is crude oil. And that goes to the Midwest Pad 2 and the Rocky Mountains Pad 4. So if all of a sudden you were to slap a 25% tariff on imports of Canadian crude, you'd be driving up the price of gasoline because the Midwest Pad and Rocky Mountain Pads can't accept the crude that we produce. They're geared for the Canadian crude. And so if you slap a 25% tariff on it, you're just making gasoline more expensive and you're irritating refiners. We're shutting down refining capacity because the Canadian crude's priced out of the market, and it's just not a good situation.
And it'll make Canada even more antagonistic to us again, even more so than they are right now. Maybe they'll even stop letting Americans try to pretend to be Canadians when we're traveling abroad.
Yes.
So the last, it's about 7 minutes left, and we wanted to touch base on AI. You've already mentioned the use of AI within the oil industry. We had a meeting a couple of months ago with a couple of folks from the chemical industry, and they were commenting how AI is naturally applied to the chemical industry as far as, I guess, predicting the algorithms or predicting the combinations of chemicals that will do this, that, or the other thing. Any other examples in your mind? Let me also make one other point. People, I think, expecting AI to instantly transform the economy. And the last major breakthrough like this was the internet. And it certainly changed the economy massively, but it took at least a decade to do so. And you pointed out, I think, when we talked earlier about this, Peter, that the internal combustion engine, it took probably a generation to change the economy and change society. So is AI going to be really any faster than the internet or faster than the internal combustion engine?
Well, certainly faster than the internal combustion engine. And I do think it's also going to have more influence more quickly in our economy, in the world economy, and in and by utilization by consumers. Things like medical technology, I already see in research labs the utilization of AI as scientists are experimenting much more quickly with the combination of, as you mentioned, chemicals. A lot of our medical science, if you will, is chemically oriented, and so the different combinations of different chemicals into different new drugs is going to come much more quickly because the analysis will go much more quickly. And the elimination of possible combinations or what we thought were possible combinations will happen much more quickly. So I think certainly in medical technology, I think in a lot of manufacturing processes already, and this has been true now for at least more than a decade, robots have been broadly utilized in several manufacturing settings. A Fanuc is a big robot manufacturer out of Japan, and their robots are spread throughout lots of especially car manufacturing. I think another one is Yasakawa Electric, also out of Japan, major robot manufacturer. The incorporation of AI into robotics, I think, is going to become pretty quickly a fascinating new field to basically work alongside, as robots do today, working alongside humans that are sort of orchestrating the manufacturing within a plant. I think you're going to see much more of that, so that what a plant that used to have to employ 600 people may only employ 200 people, but those jobs for the humans are going to be much higher ordered, and probably also and make the plant much more productive. And maybe a plant now maybe working 18 hours a day will expand to 24 hours a day, and you're going to get multiples of that spread throughout manufacturing.
I wonder if we'll have the same problem that some of these semiconductor plants, the fab plants that were being built in, I think, Arizona and to the Southwest, where they knew the skills that were going to be needed by the human capital that was being applied to the manufacture of semiconductors, and they were having trouble finding American engineers or people with sufficient skills to work in those plants. Taiwan apparently, whether the education system is designed to produce a steady flow of labor into those fab plants, and the U.S. is not, or maybe the fact that the Americans are struggle to program their VCRs might mean we're maybe a little bit less engineering ready than some of our Asian compatriots. But obviously, if people are going to need skills in working alongside a robot, they're going to have training to let them work alongside a robot. So I wonder if we'll see continuing changes in our education system to make more on-the-job training, apprenticeships, and the like, rather than taking people through 4 years of a liberal arts education.
I concur. I think so. I think that's exactly what's going to happen. It's going to be much more job-specific training as opposed to going to get a liberal arts education and being able to quote Shakespeare on the factory floor. I don't think that's going to work any longer.
Do we have any questions, Christina?
Yeah, there is one question that we received. It says, The recent CBO report states that the United States is on an unsustainable fiscal course marked by large and rising deficits. The national debt is projected to reach record highs due to the mismatch between spending and revenues. What are your expectations of whether the current administration will try to reduce the national debt and at what cost to U.S. citizens? We know that Social Security and Medicare and Medicaid programs are key factors in spending growth. Will the Chinese ask us to repay the debt? Should seniors plan ahead for reduced income from these programs?
Let me take a first swipe at that while you're thinking of the right answer, Peter. I think the current administration will make an effort. I sort of doubt that they'll make much progress. Maybe Elon Musk will apply some of his magic to finding some easy reductions in expenses. But we have to have a real, excuse the expression, coming to Jesus moment with the deficit and the debt, because we're approaching a tipping point. And the one thing that we all agree upon is the exorbitant privilege that Americans have by having their currency as the reserve currency of the world does give us the ability to run consistent deficits. But that's not an unlimited privilege.
Couldn't agree with you more, Richard. I think this has become a hot topic. And this is, I think, where the bond market, soon after the election, reacted badly, because the bond market today is more concerned than it was yesterday, and tomorrow will be even more concerned until something is done. And Richard just mentioned a tipping point. I don't know that we're there yet, but we're certainly closer. So the bond market is concerned about the deficits that we're running as a country and the debt that we've rung up. So the administration has created this advisory group called DOGE, Department of Government Efficiency. It has no executive authority, but it does have, I guess, advisory capacity. So it's going to be giving out a lot of advice. Whether the administration follows the advice or not, I don't know. But they're certainly thinking about it enough and ran on it enough that they've created this entity. Richard's right. We need to make progress on this subject.
Exactly. And Peter, I think the current batch of seniors probably is going to get through the rest of their life without major disruption. But for those people that are probably 50 to 60 now, they might face some real challenges ahead, because one of the answers is to make Social Security either needs-based or harder to get, or that the entitlement is not quite as generous as it is today. I mean, some seniors can, it's tough, but they're living with 75 or 80% of their cash flow coming from Social Security. I wouldn't be surprised to see Medicaid get cut some. Medicare is probably safe for now, but again, the next generation may have challenges that we can only conjecture about.
I agree with that.
We've gone past our hour. So
are there any final questions, though?
I do have one outstanding one. It just says, is it true that interest on debt, military spending, Medicare, and Social Security take up all of the income the U.S. government gets and everything else is deficit spending?
I think that's pretty accurate. Interest, for the first time, eclipsed military spending last year, and that was a real sort of watershed event, wake-up call. The Medicare, Medicaid, Social Security, they've been the biggest parts of the budget for quite a while. But then there was defense spending, and that was sort of sacrosanct. Nobody wanted to ever touch defense spending because we live in a hostile world. But now with interest expense having eclipsed defense spending, I think there was a collective whoa in Washington. And we better do something about this. So something's got to get done.
That's
So
all.
I think that's probably all for today. We really are very grateful and flattered by the fact that we have our guests, our clients and friends as guests today. And we hope you come back. We're going to do the call based on the commentary every quarter. So it's probably going to be within the first 2 weeks of each month following the end of each quarter. So there'll be a similar call on our commentary in April. There'll be another one in July, another one in October. But we do periodic calls also on topics that come up on a periodic basis, as well as doing a regular call for the Baldwin family office on topics like tax and planning and continuing care communities, as we did recently. So we hope you'll join us on all our calls. Keep abreast of that, not only by reading our newsletter, but also keeping track of us on our website. Thank you for coming today.
Thank you all very much. Stay warm.